Hi guys, welcome back to my channel. Thank you so much for joining me. So today we're going to talk about loan points. What the hell is a loan point? Okay, so I want to break it down for you guys and I'm going to show you if it's worth it to pay points to get a certain interest rate. So loan points go by a few different names. You might hear loan point, obviously, discount point, or origination charge. Okay, so those are some of the words that you might hear regarding this term. Basically, the simplest way to explain what a loan point is everyone qualifies for a certain interest rate. Okay, they call that a par rate. If you want a lower rate than what you qualify for, you have the option of choosing the lower rate, but it costs you money. That money that you're going to pay extra, that extra fee, is called a loan point. Okay, so it might be a little bit hard to understand, but I think it'll be a lot easier if I show you. Okay, so let me just pull up an example here. This is the bank that I use, UWM, United Wholesale Mortgage. So I have a scenario here that I've populated, just as an example. Okay, so the borrower's name is Joe. His loan is $400,000. The value of his house is $500,000. So his loan to value is 80%. He's doing a refinance. It's a rate and term refinance. It's a single family home in California. Zip code's 90046, and his credit score is 700. Okay, those are the basics. So let's just go with that. So if you hit get quote, you're going to see the par rate. So anyone says par, it means even. It doesn't cost you anything and you don't get credit. Okay, so in this scenario, as of today, again, rates change every day, so this is based on today's rates. That person qualified for a 3.74% rate. See here, rate amount 0, right? So that's what they qualify for. So let's click see more rates. Okay, so here is where you can choose to take a lower rate and pay points. Okay, so you qualify for a 3.74% rate. So let's just say Joe, this borrower, he's like, you know what, rates are really good. I want to go even lower. I want a 3.5% rate. He can do that. You can too, or anyone can. You can always choose a lower rate, but you have to pay these points. So for a 3.5% rate, Joe is paying 0.585 in points or fees. And it costs $2,340. Now, when you're doing a refinance, this fee is going to get rolled into your loan. Okay, so that's almost half a point. Now, if he wants to go even lower, he wants a 3.375% rate. That's about 1 point. It's a 1 point cost. It's a 1 point fee to get that interest rate. So he has to pay $4,216. Now, if it's a refinance, it gets rolled into the loan. It doesn't have to pay for it. So as you see on this chart, you can choose a 3.375. You can choose a 3.5, 3.625 costs $300, or you get your par rate, doesn't cost you anything. Okay, now real quickly, let me show you what happens if you go the other way. Let's say you choose a higher rate. Let's say you choose a 4% rate. Now you're going to get half a point in credit. That's what this negative is. That means the bank is going to pay you. Your rate is higher, your payment's a little bit higher, but if you don't want your loan balance going up, you don't want to pay fees, this $2,239 will cover most of your refinance fees. Okay, so it just depends on what's important to you. Do you just want a par rate? Do you want a low rate? Or do you want low costs? Right, so you can choose a higher rate, lower cost. Okay, so the question you might be asking is, well, how do I know? How do I know if I should pay points? How do I know if I should pick a 3.5, right, and pay this fee? Is it a good idea? It's a very simple way to calculate whether or not it's a good idea to pay points. The simple way to decide if you should pay points is, are you going to keep this loan long term? Okay, so let's break it down into numbers so there's no misunderstanding. Okay, so if you choose your par rate is 3.74, the payment's $1,850. That's your mortgage payment every month. If you go down to, let's say, 3.375, your payment's $1,768. Okay, so 1,850 minus 1,768, you are saving $82 a month if you choose the lower rate. Okay, but you're paying $4,216. So what I do, so you're saving $82 a month, right? So you take $4,216 divided by 82. That's going to give us the number of months that you would have to keep this loan to recover $4,216. So that number is 51. If you keep this loan for 51 months and you save $82 a month, you make up that $4,216 in fees that you paid. Okay, so that's how you know if it's a good idea. If you're going to keep this loan for a long time, over 51 months, which is a little over 4 years, if you're going to keep this loan for 4.5 years or more, it is worth it. Okay, because you're paying less interest and you recover that $4,000 that you paid. Okay, so that's the simplest way to figure out if you want to pay points. Okay, now if you are buying a house, okay, you have to figure in that cost on top of your down payment and your closing costs. So let's say you have a 20% down payment, closing costs are going to be 1 to 2%. And then if you want to buy points, you have to add that to your total cost, your down payment, plus your closing costs, plus what you're willing to pay in loan points. Okay, so when you're buying a house, that comes out of your pocket. When you're doing a refinance, that fee gets rolled into your loan. Okay, so this person, Joe, who's doing a refinance, if he decides to go with 3.5, he doesn't have to pay $4,000 out of his pocket. It just gets rolled into his loan. So his loan, instead of being $400, it's going to be $404. Makes sense? Or he has the option of bringing that money to the table at closing. He can pay cash if he wants, but most people decide to hang on to their cash and just roll it into the loan. Okay, so that's basically how you know if it's worth it to pay loan points. Okay, so a lot of times when you see advertisements as well, sometimes they're advertising the interest rate that costs a point, right? So if you see an advertisement from Chase, Wells Fargo, whatever, and they're advertising this rate, they don't tell you that it's going to cost 1 point. Okay, you might find that out later down the road that, oh wow, I'm actually paying for this rate. So that's sometimes in advertising, when you see these really, really low rates being advertised, that's what it is. It's actually costing points to get that rate. So it's important to, if you see an advertised rate, you call, say, hey, this is great. How do I qualify for this rate? It's important to ask, hey, does it cost any points? Okay, so that wraps it up. Hopefully that made sense. Please, if you guys have any questions, leave a comment below. Let me know if this made sense and if you understand now what loan points are. And if you haven't yet, please subscribe to my channel. I'm bringing you guys videos every single Friday about the mortgage and real estate industry, everything you need to know in real, like, bite-sized pieces and layman's terms so that you understand how the mortgage process works. It's simpler than it seems. So that's what I'm trying to bring to you guys. So if you're enjoying these videos, hit the like and subscribe button. And if you haven't seen this video, click right there right now. And I'll see you guys next time.